is that people would just kind of, I'd go out in the field and watch them, and they'd be 3 or 4 pages ahead of the notes and not paying attention to what I'm saying and so forth. And I didn't like that. So after I'd been doing this for a few years, I said, I know how I can get their attention, to get them to pay attention to me in class. I won't give them any notes. And I have this little pen here in front of me, and there's a writing pad right in front of me, and there's an overhead camera right above me. And what I write on this little pad in front of me goes up to that camera and then out to your TV screens around wherever you are watching. So you have to write down what I write down in here. Now what I do is I'm going to take these sheets that I write on, and I'm going to stack them up on my desk. And when it comes time to make up the exam, I'm going to look at what I gave you for notes. And I'm going to pull my exam questions out of those notes. So I strongly advocate you have either a pen or two with a lot of ink on it, or several pencils and several sheets of paper, and you take good notes. Because it's from your notes is what I'm going to make up the exams. Actually, from my notes, what I write on here is what it's going to put on the exam, kind of thing. So keep all that in mind. There won't be any tricks. I don't play any tricks. I don't say, got them, type of things. It'll be in here. If it's in these notes, it'll be on my exam. And the other side of the coin, if I write it down here, you could probably almost take it to the bank. I'm going to test you on it. Because I'm going to go through these things and make up a lot of short questions. There'll be 5 weeks of material on the exam. 20 points will come from each week. So each exam will be worth 100 points. 20 points from week 1, week 2, week 3, 4, and 5 as we go down through there. I equally weight each of the weeks. So don't say, I didn't like what he did that week, I'm going to forget that and not study it. Well, you just blew off 20 points on the exam. Okay, so it's fairly straightforward. Okay, so that's the way the deal's going to go. I've got some notes here to talk about so that I don't wander and roam all over. And yes, I could make those available to you, but I think I explained to you why I don't. So I want you to pay attention and get some notes on it and do all that kind of stuff. Now, so I'm going to start lecturing here now, and I'm going to start writing on here. And I'm going to give you right now the first question on the exam. I'm going to tell you what the question is. You've got to be able to figure out what the answer is based upon what I say. But I'm going to tell you what the question is. It's the first question. I have 2 ways of phrasing it. The first question on your exam will say, what is the goal of a firm? Incidentally, my handwriting deteriorates badly, especially after about 2 hours. So you'll better listen to what I'm saying, because I'll try and say the words as I'm writing them, because I don't write all that well. Oh, and one other aside on that. When it comes time to your exams, some of you don't write very well either. If you want to type them out in Word, that's all. I'm okay with that. So if you want to do your exam in Word, as long as you don't do too much spell check or something to get unfair advantages. You don't look things up that way, but you can use that. So for those of you who looks like there's a chicken that just walked across the page and you think that's your handwriting, you can do that in Word. And all that I ask, if there's 1 page on the exam, it's 1 page in Word. And if it's a second page on the exam, it's a different page. Because some people will try and get the whole exam on 1 page, and I can't figure out where anything is. So if I know that's page 1 and that matches with page 1 of my exam, I'm good with that. So just keep that in mind if you like to do things that way. Okay, let's go back to this. What is the goal of the firm? Or what is management's primary objective? Same question. It's the same, different questions with the same answer. You would hope management's trying to do whatever the goal for the firm is, but we can't always be certain of that. So that'll be question 1. I promise you. Now, the answer is not so short. It's going to take me a while to go through this. Some people say there is a social responsibility There's a social responsibility to business. Firms should exist to do good, to make the society and community much better off. Now, when I'm talking about the goal of the firm, I'm not talking about the goal of a nonprofit, because clearly if it's a nonprofit organization, it should have a social responsibility. Obviously, that's what's meant by a nonprofit. I'm talking about a company that's out there, what we would normally consider to be a profit-making organization. So let's clarify that, okay? And we're talking, normally speaking, about a larger organization, not just for a mom and pop store or something like that, but where there's a whole organizational context out there. Now, is there a social responsibility for business? That's one of the things in graduate school they argue about all the time. If you go to a school like Harvard where they have all these case discussions, they'll probably have 2 or 3 weeks in a discussion session where everybody will have to take pros and cons about social responsibility. But mine will be a little bit shorter answer on that. Should a corporation be allowed to move into a city, bring workers into that city, because there's not enough workers in that place, so they bring workers to work in that place, build a building, build a product, and do that for 30, 40, or 50 years, and then decide that labor costs are cheaper in Mexico or someplace in the Far East or something like that, walk away from that building, leave just the shell of the building standing, having the ground around it totally polluted, having the water supply around it totally polluted, and leaving massive unemployment left in that city. Not that I'm thinking of any city in particular, mind you. Like maybe Flint or Detroit or something like that. But is there a social response? Or does that business that move into that city have some kind of ongoing responsibility to the people in that area? Well, that's a tough question, because ultimately we're going to have to make some profits out here. And if you can make more profits by moving your business someplace else, why shouldn't you do it? But then again, what about all the devastation you've left behind? Personal opinion, I'm on a soapbox here. This is just an opinion. I think there is a social responsibility to business. I don't think that we can just pillage a community and then move on and pillage another community and move on and pillage another community and so forth down the line. I think we have to do the socially responsible things. I don't know what that means exactly, but we have to have somewhere in our brain, we have to say, we have to look at the people that work for us, the people in our community. What is the impact that this decision is going to have on those people? I don't know necessarily if we're a profit-making company, that should be our primary goal, but it's something that should be part of our decision-making process. In this course, I am going to ignore the social responsibility of business. It's mainly because I can't quantify it. Since I'm an undergrad engineer, I want to quantify everything, and I can't quantify social responsibility. So I think it's important, but it's not really the answer to my question. Okay, so it's not the answer that I'm going to look for. So on the exam, don't put that as the answer. Don't put that as the answer. Okay. Another answer that some people put out there are managerial goals. Managerial goals. Does a company exist so that the top management makes a lot of money? If you look around the United States right now, there are some top managers that make $50 million, $60 million, $80 million a year. Even if the company is losing money or barely making money, we find top managers making these extraordinary salaries. And if you're in charge, if you're the top manager of a large corporation in the United States, pretty much certain that you're making $10 million a year, at least. Of almost any of the top 1,000 corporations in the United States, almost all those people are making many, many millions a year. A little bit later on this semester, the Wall Street Journal will put a report out, and it says the top 1,000 corporations here's what these people are making. And it takes them about 10 pages of the Wall Street Journal, lists all these corporations and all the sources of money. And it's really scary when you see all the money that people make in the United States as top management. We see some top managers having their own airplane, their own private office or condos, and Lord knows where, and whatever, all these perks and benefits that they get out there. And sometimes we get the feeling that the goal of management is to take care of managers. And unfortunately, I hope it's in a small number of cases, but maybe it's in a larger number of cases than I think. The goal of the firm is to take care of top managers because top managers take care of themselves. I don't like that as a goal of a firm. I don't think that should be the goal of the firm. I don't think that should be management's primary objective. I think if they fulfill what I'm going to give you as the primary objective, they should be well compensated. But if they don't, I don't think they ought to get anything. So I think the compensation that management gets and the perks that they get and whatever else should be a function of how well they do what I'm ultimately going to say is the goal of a firm. So, okay. So let's not use that as an answer. So that's not an answer to my question. Now, for anyone that's had Econ 101, which I hope all of you have had the course in economics, you're going to tell me is to maximize profits. Did you learn that in economics? That your goal is to maximize profits. I want to go through right now and explain to you when an economist says the goal is to maximize profits, what the economist means. Because what you think it means and what the economist thinks it means aren't the same thing. Because you all think that, well, the goal of the firm is to make this big pile of money. Not so fast on that. Let me talk about this. First of all, I'm thinking of two companies. One of the companies I'm thinking of is General Electric. I use General Electric a lot as an example just because it's a big company and everybody knows what I'm talking about when I say General Electric. Let's suppose General Electric makes a profit of $5 billion this year. A lot of money, isn't it? Is that a lot? Is that a good profit for GE? Anybody? Okay. Second company I'm thinking of, probably one that you didn't know existed till tonight. It's called Neil McCarthy. Me. I do some consulting. I don't do much anymore, but I used to do quite a bit when I was younger. What if Neil McCarthy makes $50,000 in this year? Who had a better year? Neil McCarthy at $50,000 or GE at $5 billion? Well, in case you don't know it, $5 billion is a lot more than $50,000. Some of you might not quite figure that out yet because it's hard to envision $5 billion, but $5 billion is a lot more money. So the immediate knee-jerk reaction, oh, geez, spectacular compared to you, Neil. And I say, not so fast. Do you have any idea how much GE's assets are worth? Do you have any idea at all? I'll tell you what they're worth. They're worth in excess of $800 billion. The stockholders of GE have invested $800 billion in that company. $5 billion on $800 billion? It's less than 1%. It's far less than 1%. It's less than 0.1%. It's peanuts. It's terrible. Do you realize how much assets I have invested in my company? Careful now. But yeah, let's say I've had $50,000. I made $50,000 on my $50,000 investment. That's spectacular. Who had a better year? If I made $50,000 and if GE only made $5 billion. Now GE makes a lot more than $5 billion. But if GE only made $5 billion and I made $50,000, I had a better year. Because when we talk about maximizing profits, first thing we're talking about ROI. What does ROI stand for? return on investment, or return on assets, as we sometimes call it also. So if GE makes $5 billion on $800 billion, it's nothing. It's a terrible year. Fire the buggers. They didn't do a good job. If I make $50,000, my wife ought to give me a gold star. She wouldn't do that either, but it's a pretty good year. And so when we talk about maximizing profits, we're really talking about maximizing ROI. Keep that in mind. That's really what they mean by that. A second thing, one of my consulting jobs, this goes back a few years ago, I got a call one day. It was a young lady on the phone. She identified herself. She said she was an engineering graduate of this school as an undergrad, and then gone out and got herself a degree in law. So she was a practicing lawyer. And she said she was defending a client who was being sued, and the person that sued them had gotten to a college professor who had presented a position paper why her client should pay millions of dollars to the person that was suing him. And she wanted to know if I could look at all the data that they, of the information, and write a position paper defending her client. I said, well, send me the information and I'll see what I can do. And she says, oh, by the way, we'll pay you $100 an hour. You keep track of your time. Now, will you work for $100 an hour? Absolutely. Well, this was about 15 years ago when it was really good money. So I said, sure, I can do that. Yeah, I'm good. And so she sent me all this data, and I read through everything and put together a nice position paper. And pretty well, the other professor was just blowing smoke. I could tell that, and I pointed out where they were just blowing smoke and what was just nonsense coming out of it. And wrote a very nice position paper, sent it off to her, sent it to her an email. She looked it over, said, perfect, just what I needed. I says, you want to pay me now? Here's my hours. She says, oh, no. She says, this might go to court. And if it goes to court, you're going to come in and have to testify. And I said, well, whoopee, I'm going to love being in court, testifying. And she says, when we settle, we'll pay you your money. And I said, no, I'm stupid sometimes. I said, okay, stupid. Why? They didn't settle for 2.5 years. Never did go to court, but I waited 2.5 years to get my check. When she said, well, we don't pay till we settled, would I have been better off saying, well, I'll take $95 an hour right now? Would I have been better off taking $95 an hour right then rather than waiting 2.5? Why? It's the concept known as present value. That's that we're going to use Excel for in here. It's worth, they have to pay me a lot more in the future versus what I get right now if I'm going to have to delay this. So it's a present value concept. It's a present value. So the second term here is it's the present value of the ROI that's important. Don't tell me you're going to get the money 5 or 10 years down the road. What's it worth to me today? So that's that concept of present value, and hopefully everybody is familiar with that concept. So you understand that. So when we say maximize profit, we're going to maximize the present value of the ROI. Third thing, I got a lot of little caveats here. As I reach into my pocket, see if I have a coin out here. Boy, I need to get a bigger allowance from my wife. All I got is a nickel. All right, take a nickel out of here, and I flip up in the air, and I said, if you call that correctly, I'll double your salary next year. So your boss comes up to you and says, here's a nickel. I don't know what you're making. Now, let's say round numbers, you're making $50,000 a year, okay? Your boss comes up to you and says, you call this coin toss correctly, I'll make it $100,000 next year. You won't have to do any more work, no overtime or anything, just I'll pay you $100,000. You call it incorrectly, you still work for me, you do whatever you're going to do, but I ain't going to pay you anything. Anyone willing to go double or nothing on their salary? I would hope not. And you say there's something to do with risk there, right? So the third thing here is risk. We're going to spend next week talking about risk. We're going to spend a lot of time talking about risk in here. So, but just intuitively, if there's a lot of risk, we want that ROI to be even higher. Would you take a safe return or just a slightly higher riskier return? Or would you take a safe return and a very much higher riskier return? Well, the very much higher riskier return might appeal to you. So when we talk about maximizing profits, it's the present value of those profits, but we need to adjust them for the level of risk. If it's a very risky company, one that might go real high or real low, I want a better return. If it's a company whose earnings look like just goes up steadily like that, we love that. So I'd be willing to take a little lower return if they would just grow like that instead of doing something like that. So when we talk about maximizing profits, we have to adjust it for risk. And then we're going to talk about that a lot next week. Wow. Don't like this maximizing profits, do I? Got one last thing. The fourth reason. I don't know how many of you own stock. Some people own stocks in company and some people don't. You can just come straight ahead for a second here. Well, when a company makes a profit, what does it do with that profit? There's only two things they can do. They can pay dividends or they can reinvest it in the business. There's only two things a company can do. They can pay dividends or reinvest it in the business. What if your company decides to maximize profits? How much dividends do they pay? Well, if the goal is to maximize profits, then you never pay any dividends. Never. Because you get a bigger company that way. You reinvest more money in the business. Would you want to own stock in a company that has never paid a dividend and has a policy that they're never ever going to pay a dividend? And you tell me, yeah, well, sure, I'd do that as long as when I bought it for $30 a share and I can sell it for $60, I can do that. But why would someone pay you $60 for a share of stock that's never going to pay a dividend? Well, you tell me that because they're going to plan on selling it to someone at $90 a share. Well, what I'm describing is what we in finance call the greater fool theory. I bought it because I was a fool, and I plan on selling it to an even greater fool. If there are no dividends, money going back to the stockholders have no reason to buy the stock. They're getting the short end of the deal. If we pay dividends, we're obviously not going to grow as much as we could have if we didn't pay dividends. So we can't say our goal is to maximize profits because inherently that's not a good thing to do because we got to pay some dividends. So I'm going to write down the word dividend here. And I'm going to draw a big circle around this and put a line through it. What does it mean when you put a line through something? That ain't it, folks. Okay, now, I could have made this a short lecture and just given you the answer straight on. But you still would have been telling me the goal of the firm is to maximize profits. And we'd have been arguing about this all semester. And I didn't want to argue about it all semester. I want to get it over with quickly here. What is the goal of the firm? Answer. There's a variety of ways of answering this. What I write here is only one of the variety of ways that you could do it. I don't expect you to memorize an answer. I expect you to kind of internalize the concept and be able to give me something back, okay? One way of answering this is to create value for stockholders Another way of saying is maximize stockholder satisfaction. Some people will just tell you to take care of the stakeholders. How do you spell steak? S-T-E-A-K? That would be something you'd eat, wouldn't it? So it's take care of the stakeholders. So any of these are pots. Are they all saying the same thing? That's all. Take care of the people that own your stock, okay? Take care of maximize what they're going to get out of it. Now, that's only the first half of the answer. For those that own stock, what puts a smile on your face on a fairly regular basis, hopefully? Well, if you own shares of stock in a company, and you look up in the Wall Street Journal or your local newspaper, and what do you look up on a daily basis? The price of the stock. And what puts a smile on your face? The price of stock goes up. What puts a frown on your face? When the price of stock goes down. So we want to put the smile on their face, right? And that's the big smile. That's what that means. That first part of the answer is put a smile on your stockholder's face, okay? And no matter which of these, go ahead, put the overhead on your second. No matter which of these you want to go with, or any variation that you yourself want to create, I don't care. We have to put the second part of it, measured by the long run price per share of common stock. Measured by the long run price per share of the common stock. Now, some parts of that I want to emphasize. First of all, long run. Google stock came out at about $60 a share, and I don't know what it is now. It's like $600 a share or something like that. Is Google an example of a company that's met that goal? And the answer to the question is no. Because Google's only been around for, what, 2, 3, 4 years? I don't remember, lost track of time here, but let me say 4 years. That's not long run. You come back in 20 years and you tell me what Google's stock price is, and then I'll tell you whether or not they've met the goal. General Electric started back about 1880, something like about 130 years ago. General Electric's been around for 130 years. And their stock has had its ups and its downs. Right now it's a little bit on the downside. But over 130 years, the price of their stock has more or less gone up. So you could argue that GE is now in the long run and has met its goal. It's met its goal. For those of us that live in Michigan, we have Chrysler and General Motors, which for a long number of years did quite well, but a couple of years ago went in the tank. So they failed to meet that goal. So any company that goes bankrupt is a company that has failed to meet that goal. As part of the question on the exam, I frequently say, give me an example. So I'm just going to make myself on a little note there. Make sure you can create an example of a company that has met that goal and a company that has not met that goal. And if I ask you to give me that example, don't tell me Google. Don't tell me Microsoft. That's not an answer. The answer is Microsoft, because over the last 30 years, the price of Microsoft stock has gone up significantly. Tell me some other company, this example of a company that's not met that goal because they went bankrupt, or the price of their stock has gone nothing but down over the last 20 or 30 years. So when I ask for an example, I want a company name, and I want something which says the price of the stock has either gone up over a long period of time or the price of the stock has gone down over a long period of time. It's not just the one-word answer. In the past, I've gotten people that have done that. Okay? So from now on, when we look at a company and we say, how good has their management done? You tell me what's happened to their stock price. And what we see over and over again, I read the Wall Street Journal on a daily basis. The school is kind enough to supply me with a copy every day. And what I see over and over again, this company is replacing its CEO. Why? Because the stock price has gone down. You never see a CEO getting replaced in a company where the stock price is zooming. Almost never, anyways. As long as that stock price is going up and going up significantly, then that management has done their job. They've met, that's management's primary objective, they've met the goal of the firm. If, however, even though there's a short-term blip up and then a huge crash down, that's no good. Going back as an example, Merrill Lynch. Merrill Lynch was an independent investment banker / brokerage firm on Wall Street. Up until over the last 40, 50 years, Merrill Lynch's stock price, well, actually, once it started selling, it was much more recently than that, but its stock price went up and up and up. And then a couple of years ago, it crashed and burned and essentially got bought out by Bank of America, essentially went bankrupt. So you could have said, well, Merrill Lynch, great company, crash and burn. No good anymore. They haven't met their primary goal, okay? So just kind of something for you to kind of remember about all those kinds of stuff. So that's what the goal of the firm is. What's prime management's primary objective? Remember that. When we look later on this semester and we say, is this a good decision or a bad decision? The answer should be, it's a good decision if the stock price, if it's going to lead in the stock price going up in the long run. It's a bad decision if in the long run the stock price is going to be adversely affected. Keep in mind social responsibility. Keep in mind that management also takes care of management. Okay. Second topic I've got here tonight. And this will be the second question. If you listen closely, my exam should not be any surprise to you. Okay, because I tell you what they are. I have 7 principles of finance that I'm going to cover. I will pick 1 or 2 of these 7 principles. I'll give you a short version of the principle, and I'll ask you to explain it and give me an example. So I'm going to give you 7 different principles. Now, this book that you've got, this textbook that you've got, is now in its 11th edition. They just came out with a new lead author. The editions 1 through 10 had 10 principles of finance. The chapter edition 11 has like 5 or 6. So I compromised, and I'm coming up with Neil's 7, which are all in your book, plus a couple that were in other editions that I think are really important type of thing. So that's where the 7 principles are coming from. It's not 10 like it used to. It's not 4 or 5 like they got in the textbook. It's Neil's version of what's in the book plus some extra ones, okay? The first basic principle of finance, a risk-return trade-off. A risk-return trade-off. I'm going to cover this in more detail next week, the risk-return trade-off. It's a major topic in finance. It's the inherent basic principle of finance. But the short answer on this is we will not take on additional risk without additional return. We will not take on additional risk without getting compensated with different. Remember I talked earlier about going double or nothing on your salary? Well, what if the person that was making the deal said if you call it correctly, instead of 0 or 100, what if I made it 0 or 200,000? Anyone willing to go on a coin toss on your salary? Or if you call it correctly, you get 4 times your salary. And if you call it incorrectly, you only get 1 time your salary? I got to think about that one. I can probably afford to do it. You probably can't. But I can afford to work for free for a year with the risk of getting 4 times as much, or a chance of getting 4 times as much. But that's a risk-return trade-off, is it not? Now, I can take my guaranteed salary, no risk, or I can take the risk on the coin toss and getting additional return. Let me give you an example of this. Because I'm going to ask you, if I give you these, I want you to be able to give me an example. You've got some money to invest. Should you invest in bonds or stocks? It's one of the basic things as you start to accumulate some wealth and you make some investments. Where are you going to make those investments? Are you going to put it in the stock market or the bond market? Well, if you invest in safe and secure bonds, and I'll define that better later on tonight, you get 4-5% return. Over long periods of time, bonds get 4, 5, 6% return. If you invest in good solid stocks, they tend to get 8, 9, 10% return. Well, let's see. I'd rather get 8, 9, 10% than 4, 5, 6, wouldn't you? Except the risk involved. Bond market, your returns are nice steady line, right straight across. Your returns on the stock market, when I said 8, 9, 10%, 2008. You want to look at my portfolio in 2008? Can't believe how many hundreds of thousands of dollars my portfolio went down. 2010, 2011, when the market recovered, you have no idea how much my portfolio went up during those periods of time. But tough on the ticker. If it had been all bonds, I'd have just sat there and watched it grow like grass. Risk-return trade-off. We will not take on additional risk without additional return. Bonds have minimal risk. Stocks have a lot of risk. Stocks better get me a greater return because there's an awful lot more risk. If you have 2 projects to approve, do you automatically take the one with the higher return? The answer is no. There might be an awful lot of risk. So you have that risk-return trade-off to look at. Anytime we have choices, it's not just which one has a higher return, it's how much risk is associated with it. And we look at the risk-return trade-off. We have that ongoing dilemma, risk-return trade-off. A little bit later on, we're going to talk about bonds, and we'll talk about things that rate how risky they are. And what we're going to find is that some bonds get you that like a 4% return, and some bonds get you like a 10 or 15% return. Now, why would some bonds get you a 4% return and some bonds get you like a 15% return, even in today's market? Answer, because the ones getting you 4 or 5%, very little risk. The ones that have a 15% return, you might get it. And then again, you might not get it. An awful lot of risk. So even within bonds, they're not all bonds are the same. Same thing within stocks. Some stocks are very stable and solid. Some stocks are all over. High-tech stocks, small companies, new companies, very volatile, very risky. Better get a good return on because there's a lot of risk. Some other companies typically have some very stable returns, not so much risk. Risk-return trade-off. Okay? Basic principle of finance. Second one. Cash. Not profits. Is king. Cash is king. What does that mean? Why isn't profits king? I thought we'd like to maximize those profits. And now I'm telling you cash is king. Well, let's look at a couple of things here. First of all, cash flow and profits are different. Cash flow and profits are different. And in finance, we look at cash flows. We don't look at profits. So these two are different. For example, I'm a manufacturing company, and I build a product. I manufacture, put some labor, materials, and overhead and so forth, and I manufacture a product. Somebody comes in and buys my product. Let's say they buy it on December 15th. So I ship it out the door, and then they agree to pay for it 60 days later. So if I build it, I sold it to them on December 15th. I don't know what 60 days later, February 12th, I guess would be. Something like that. It'd be 60 days later. When does the accountant say I made my profit? The accountant says I made my profit when I shipped it out the door, December 15th. What does the finance person worry about? When did I get the cash? I didn't get the cash till February 12th. Cash is what we look at here. I don't care that the accountant said I had a profit on December 15th. As a finance person, I care that my profits weren't, or pardon me, my cash was not here until February 12th. That's all I care about. I don't care about those darn accountants and when they're booking the profits. I gotta be careful because I also teach accounting. But in finance, we really look at the thing known as cash flow. Cash flow, cash is king. And this will come into play week 3. I'm going to come back on this one on week 3 a lot. Because when we start looking at it, we ask ourselves the question, what is something worth? It's always based on the cash flows that something generates, not the profits that something generates. So analysis in finance is always done on a cash flow basis. So if you want to put here cash, not profits is king, it means financial analysis is always done on a cash flow basis. Now, I covered this topic years ago in an undergraduate class, and for some reasons the students liked that class. I'm not certain why. At the end of the semester, it was in December, so it was just before Christmas. They came into me in the final class and said, "We have a present for you, Professor McCarthy." And I go, "Uh-oh, what is this going to be?" And they had this little plaque, and on the plaque it says, "Happiness is a positive cash flow." What better present could you give to a finance prof? Happiness is, I've still got it. It sits on top of my computer in my office. Happiness is a positive cash flow. So remember that. So you might want to write that down there. Happiness is a positive cash flow. That might be an explanation of that one, okay? So remember that. Happiness is a positive cash flow. Everybody have a positive cash flow? Maybe some of you aren't so happy. The third one, the curse of competitive markets. Curse of competitive markets. In economics, did you study competition? Perfect competition, supply and demand, and all that stuff? Let's see. If you had perfect competition, now I'm trying to go back. It's been a while since I've been perfect competition. You had a lot of producers and a lot of consumers, right? Perfect competition. So it was a large number of producers and a lot of people were consuming that product. If you only had one producer, it was called a monopoly. 2 or 3 was called an oligopoly and all that kind of stuff. And you remember those kinds of things. All right, the curse of competitive market. We do not want to sell in a competitive market. That's what that means. We do everything possible to eliminate competition. Why? What's the curse of competitive markets? When you have competition, competition drives down prices. That's the curse. Competition drives down prices. As a producer, we do not want to sell in a competitive market. As a consumer, what do you want to do? You want to buy in that competitive market. As a consumer, you want as many different suppliers as possible. Let's see. One of the sore points I've got right now, because I just looked at my bill from Comcast. Is Comcast a competitive market? I cuss them every month when I write that check. Because we get our internet and our telephone, and we get the whole shebang, and I have one here and one in Florida. I'm paying 2 of those bills. So I have a lot of cursing I do at Comcast because there's no competition. If there were competition, what would happen to my product, my bill every month? It it'd be probably a third of what it is right now. There's absolutely no reason why they charge the price they do other than they're just flat out gouging me, because there's no competition. So the curse of competitive market. Let me give you another example that maybe your generation can understand here a little bit. When I went to school, a long time ago, first one away to college, boarding the airplane to come flying out here to Flint, Michigan, my dad says to me, Neil, I want you to write a letter home every week. Now, for those of you that are from some other part of the country or other part of the world, do you write home every week? Well, after I'd been here about 4 weeks, I get a phone call from my father, and he says, we're still waiting for that first letter. Does it sound familiar? And he says, look, you ain't going to write us a letter. Can you at least call every week? I said, yeah, I can call. I can call collect anyways. When I called collect for a 3-minute phone call back then, it was $1 on a Sunday night. How much do you pay for a 3-minute phone call now? Some of you say it's nothing, it's all part of my plan. Some of you say I have calling cards and I do it for 2 or 3 cents a minute or something like that. It's almost peanuts. Why did it cost me $1, which is like $5 today? Why would it cost me $5 for 3 minutes where you can do it for either nothing or for a couple of pennies? Back when I was going away to college, there was the telephone company called AT&T. How many different ways can you make a phone call? Yeah, I have a friend of mine that we work with in terms of international programs, and we send students to Germany. He sends German students here. And I Skyped him this weekend, and he was on vacation in Switzerland. So I Skyped Switzerland. How much did that cost me to talk to him on the Skype for nothing? Now, he had never Skyped before. He couldn't believe it. Here I'm sitting on one end, and he's sitting on the other end, and I have my grandson sitting on my lap, and he'd never seen my grandson before. He was, I can't believe this. What's it cost us, Neil? It's a free call. Free call. The curse of competitive markets. When I was younger, there was AT&T, and that was it. If you wanted to talk on the phone, you talked AT&T. That was it. No other way. Today, all different kinds of ways of doing it. Curse of competitive markets. Okay? Everybody got that? You understand what it is? The fourth one. I think I got just time enough to get this one in. Yeah, look back there, see how much time I got. Efficient capital markets. Efficient capital markets. It means, did I get a fair price? And how quickly? So, now let me take this back a step at a time here. What is meant by a capital market? Capital. The word capital, C-A-P-I-T-A-L, not O-L, A-L. Capital market means a place where securities, stocks and bonds and other kinds of securities can be bought and sold. That's what's meant by a capital market. An efficient capital market means, did I get a fair price? And how quickly does it take me to sell it? Let me go through that one step at a time. I have 100 shares of GE to sell right now. Could I stand outside the building out here on the corner of 3rd and Chevrolet with my 100 shares of GE and say, who wants to buy these things? Yeah, I can. You can do that. I don't have to go through a stockbroker. I can just stand out in the corner of 3rd and Chevrolet, and if someone comes along without a gun, it doesn't hold me up, but if someone comes along and with enough money, we can cut a deal back and forth. First of all, did both the buyer and seller get a fair price if I did it out in the corner of 3rd and Chevrolet? I might get some sucker to offer me $200 a share for GE when it's currently selling at, say, $20 a share. Or I might only get $10 a share. An efficient capital market means both the buyer and seller got a fair price. Both the buyer and seller get a fair price. Secondly, how long is it going to take me to sell that stock? How long am I going to stand on the corner of 3rd and Chevrolet? 3rd? It's not 3rd anymore. University Avenue. I got to get the right school. University Avenue and Chevrolet. How long do I got to stand out at University Avenue and Chevrolet before I sell it? A minute? An hour? 10 days? A month? A year? Might be a long time. What we want for a capital market is when you want to buy or sell, you get a fair price and you do it like that. We measure the length of time in nanoseconds, whatever that is. I don't know it. They tell me that's a short period of time. Okay? So we want it to happen really, really quickly. So efficient capital markets. We've got to have, in order for us to have markets that work properly, they must be efficient. Got to do it quickly. Now, week 5, I'm going to talk about capital markets here. I'm going to talk about New York Stock Exchange and NASDAQ and some other kinds of things. We're going to talk about fishing. And I'll spend more time developing this concept for you. But do we get it quickly, and do we get it fair price? Very, very important. Okay, let's take a break. We'll come back, and I got how many? 3 more to go cover.